Okay, hi guys. Welcome to the FX Street webinar. Happy New Year to you all. My name's Ian Coleman. I'm one of the traders and analysts at firstfortrading.com. We provide analysis and trade recommendations on a total of 23 products. So FX majors, crosses, stock indices, fixed income, and commodities. Okay, on an intraday, Tuesday to Friday, and on a medium-term basis as well. We're going to basically look at some long-term time frames on the major currency pairs and see basically how far we can get through the different majors. Now, I've been writing or producing webinars, etc., for FX Street, I think for about 4 or 5 years now. And when we first established our relationship, I used to do a daily post or a daily blog a long time before even Forex Net or FX Street Net was live. We used to just blog, so that it was less interactive. But we used to do something called a time frame breakdown. And we'd pick a different currency pair every day, and we'll break it down from sort of longer time frame charts. So we'd look at a weekly chart down to a daily, 4-hourly, and then all the way into sort of 15-minute charts to try and get our intraday trigger levels. And I still like to do this. Obviously, my medium-term calls, medium-term analysis is based more around the bigger picture. Okay, so we might have 100 pip stop, 200-300 pip targets in some of the FX majors. Obviously, our intraday calls are a lot tighter. We're looking at 30 tick stops, 40, 50, 60 tick target levels. But we should never, even going all the way out to a monthly chart. Obviously, it's the start of the year. So it's a good time to reflect back and see what has happened through 2013, what price action we've had, and also what our expectations are, at least for the first quarter of 2014. Now, you might say, well, it's crazy looking at a monthly chart. I'm not going to be able to trade off a monthly chart. The stops are far too big, etc., etc., etc. And I agree with you, but chart price action is the same in every time frame. Okay, the difference being is that the larger time frames have more relevance to the shorter time frames. So, for instance, a bearish outside day on the daily chart is going to have more influence about the overall price action than a bullish outside 10-minute bar at a fib level. So we've got to keep our minds open. I'm not suggesting that every day you go back and have a look at the monthly chart, the weekly chart, because if you're looking at these things regularly, then you should know really what's going on or what your view is. Okay. Trading is obviously about having a bias. Okay, so we'll either have a bullish bias, a bearish bias, or we'll have mixed bias or mixed signals, and we want to trade with that bias. It doesn't mean that we can't have a short-term bullish bias and a medium-term bearish bias. So, for instance, we're bullish on euro-dollar this morning, but we think this is a wave correction, a corrective pattern in a longer medium-term bearish call. So, as I always do, this is basically how I break down my chart. So, what I do every morning, around about 5 a.m., I look to the dollar index, okay, because I'm analysing all the FX majors first, and because they're predominantly dictated to by the dollar, okay, I want to have a good bias in the back of my head about what I think the dollar is going to do that day. Okay, I'm also aware of obviously what figures are coming out, whether or not it's going to be dollar denominated or whether it's going to be European figures, i.e. today, pretty lacking in dollar releases, in US figures this afternoon, had some decent European figures this morning. So really the bias this morning has been dominated, or the focus of trading this morning has been dominated by the euro. So going back to the charts, so we're going to break it all the way down. We're going to look at a monthly chart very briefly, okay? Then we're going to break it down to weeklies, dailies, and we're going to look at vanilla charts, okay? So we're not going to put anything on these charts until later on, because we just want to purely see price action. The only thing that we'll probably look at is trend lines and fib levels, okay, and what the charts are dictating to us. So when we look to a monthly chart, what we're looking for is what they call an AMR, which is an acute monthly reversal candle. Okay. Now, to me, an acute monthly reversal, the candles that I like to see are outside bars. Okay. I also like evening stars and morning stars, but I'm not fanatical about dojis. Dojis are just a price rejection at that point. So a lot of the time we'll go up to a trend line, we'll spike. Some traders will sell into it, they'll move lower. It's normally scalpers, they'll take profit, and then the spike gets taken out, and the trend line gets broken, and we move to the upside or the downside, whichever the case may be. I'm not fanatical about bearish and bullish bars, okay? Because again, they're not as strong as an outside bar. Now, this is a typical chart. So we've got the dollar index, okay, and it's a weekly chart. Now, an outside bar, what we want to see is a bearish outside bar. We want to see that bar make new highs, and then we want it to close on new lows. So it has to take out the whole of the previous candle, and this is the strongest candle formation I believe that you can get, okay. Because basically what it's saying is, yes, the bias was to the upside, and yes, the bulls were in control. They've lost control, so much so that the whole of that previous candle has been reversed. Now, I also look to the ATR. Okay, so ATR is average true range. So I have an ATR setting of 15, which I like to have settings of 15 in most things, including relative strength index, because it's closer to a fib level, and I'm very fanatical about fib, but we won't get too much into that. So I want to see the ATR, and I want to see the ATR, I want to see that candle stronger than the average ATR. Okay, so I want to see it stronger than the average true range. Is anybody else struggling to hear me at the moment? Omar's saying that he can't hear anything. Okay, great. Okay, so we're just going to use this. I'm not going to put the ATR on because, like I said, we're just going to use sort of vanilla charts to give us these bars to start with. Okay, so here makes a new low, then takes out the previous candle. Then it takes out two candles actually. Obviously, the stronger the signals are at the highs and the lows of price action. Okay, so here again takes out two previous bars, and here, okay, and here, blah blah blah. Okay, so they are strong reversal candles. Now, obviously, the opposite to, let me just clear this if I can. That's it. The opposite to an outside bar is obviously an inside bar, and it tells us exactly the opposite thing. An outside bar tells us a strong change of bias. An inside bar tells us that the market doesn't have a clue what it wants to do. Okay, it's stuck within a range. Now, a lot of the time we'll see inside bars and then another inside bar and another inside bar, and that will cause a symmetrical triangle formation, which we know is a consolidating pattern. Okay, so these different chart formations and a different bar chart, they form channels, symmetrical patterns, wedges, etc., which are also great signs. But for the time being, we just want to be looking at outside and inside bars. So we're just going to break this down into the monthly. Okay. Now we can see here that obviously since 2008 we've been consolidating. a decent outside bar off the top, which took it lower, etc., etc., etc. Okay, but we are in a large consolidating triangle formation. Now, we're not going to wait till 75 to trade or to get to 85 to trade. Okay, so we're looking for a bias inside this triangle formation. Now, what will happen if you get an hourly or a daily triangle formation? The trade gets smaller and smaller and smaller and smaller until we get the breakout points at the end. Okay, it gets more and more volatile as we get towards the end of that triangle formation. Could be 2014, 2015, 2016. We don't know yet. So, but we want to break it down. So we know that we're in a symmetrical triangle formation. We know that the long-term bias with downside. Okay, because it's at the end of a bearish move. So a symmetrical triangle at the end of a bearish move has a bias to break to the downside. Okay, so back to weeklies. We have one dominating force here at the moment. Let's just widen it out so we can see it a bit better. Okay, which is this outside bar, okay, off the top. But, and there's always buts in analysis and breaking down price action. Okay, we're just going to lay our fib on. So we're taking it from the last swing high to swing low. Okay, it was a decent signal here at 61.8%. Okay, but what have we seen now? All this price action within this very large consolidating triangle formation is in three waves. Okay, three wave patterns are corrective. Okay, it doesn't matter if it's in a 5-minute time frame, an hourly time frame, a daily time frame. Okay, 3-minute patterns are corrective. Okay, we know that from Dow theory. We know that from the Elliott wave theory. Okay, 5-wave patterns are impulsive. Okay, there's obviously a lot of different ways that people look at 5-wave patterns, whether or not they overlap, etc. But again, we're not going to get too much into that at the moment. But obviously, we got a decent signal, weekly signal there. We came down and then we broken higher. Okay, 78.6 is the next relevant Fibonacci level. Okay, because that has a tendency to form the bearish Gartner formation. But like I said, the fibs aren't holding very well. This support here around 79, the figure, is decent support, but it's just because it's previous lows. Okay, but what we have got in this formation, okay, is 3-wave patterns. 3-wave patterns inside 3-wave patterns. So here's 1, 2, 3. Here's 1, 2, 3 with 3 waves inside. Okay, and even 3 waves inside the 3 waves. Okay, down here. So it's sort of dictating that we're in just a very large corrective pattern. Now, if we then look to break down this time frame, and remember that the weekly chart is dictating here. This is the outside dictating bar, if you like. So we break it down to the daily. Even far clearer, you know, this 3-wave pattern. Okay, so if we put our fib on, okay, and then we want to use just a line tool. So we're just clicking on a basic line tool. What will happen is it'll mirror this line tool. Okay, so if this is the top of that weekly engulfing pattern, okay, then we should only expect a 3-wave pattern back to the upside because it is corrective. But, and again, this formation here, this outside day in the dollar index, which was just before Christmas, 18th of Dec, has given the medium-term bias, or the short to medium-term bias, a bias to the upside. Now, an ABCD formation, of course, we like it when things line up, okay, is 82.02. 50% retracement of that last move low is 82.01. So the bias for the dollar index is to the upside in the short to medium term. And we're looking at a daily chart here, at least for the next 2 weeks, 3 weeks maybe, we'll be looking for upside pressure. Okay, we'll only then change that bias if we get a decent reversal formation around that 82 level. Otherwise, we'll obviously keep on looking for higher levels. So we're looking for reversal patterns at relevant fib levels, at relevant measured moves targets, which basically what this is, it's an ABCD formation. Why only 2 weeks to the upside? I'm saying in the short term, this is, if you look at how long it's taken this correction to form, okay, that was about 4 and a bit weeks. Okay, I don't use time spans. Elliott wave, or you can use a function on Elliott wave that gives you time spans. I don't. I'm guessing that it's going to take about 10 days to go up there. It might take 2 days. But my bias is for a move towards 82, the figure. So that's given us a medium-term bearish bias on the dollar index, but with the short-term bias still being to the upside, at least for a move to 82, the figure. And that's obviously what we're trading over the next however many days until we reach that preliminary target level. We'll then review it when we get to it, okay, if we get to it. So breaking that down into other time frames, I'm going to talk a little bit in a minute about DMARC, because obviously these are completely plain charts, so I've got no moving averages on it here, etc. These are trade myself. I use these charts to give me a bias. I then have my own system that I overlay on the charts. It's very similar to it. I have a big bias towards Fibonacci levels. I have a big bias towards outside and inside bars, but I do break things all the way down into 3 minute, 1 minute time frames to get my trades. And I also look at an indicator called the DMARC sequential indicator, which basically indicates, and it is an indicator, so it indicates exhaustion points. So as I'm talking about there, got the dollar index looking towards 82. I'll then look for either outside bars or an outside day around 82, the figure, or I'll be looking for DMARC to basically tell me that there's an exhaustion count around that level, and that will then flip my bias to the downside. Okay. Obviously, one of the big problems that majority of traders have is that this chart package is a Saxo Trader chart package. It's free. Tom DMARC you have to pay for. I use, like I said, for most of the charts that we publish, we use Saxo Trader too, because it is a great free charting software from Saxo for my other indicators and for my system. Believe it or not, I haven't got millions of screens in my office. I've got a base screen which is the size of a medium-sized television, which is one of these LG widescreens, which will get most of my charts on. I've then got split screens at the top, and then I've then got a laptop next to me, so I've got a total of 4 screens. I had a Russian guy build my system for MT4 that highlights my support and resistance levels. So I've got an MT4 on my laptop with my trading platform. I've then got 3 screens that I then monitor for for my charts basically, because I look at 15 different currency pairs. It's nigh impossible to get it off one screen. So I use Aspen graphics, which I've found to be fantastic actually, because you can mirror the charts so quickly, and I use them for the DMARC signals, or analysis I should say, because every book you read about DMARC is not a system. It's not a system. It's an indicator like everything else, and an indicator should be used in conjunction with something else. What graphics? Aspen, ASPEN, Aspen graphics. They've got an office in London. Okay. So getting back, where were we? Digressing again, Mr. Coleman. Okay, so I'm going to talk a little bit about that in a minute. But what do you say is going on here? You'd say, well, there's consolidation. You'd say it's probably in a channel, and this is what I'm saying about a lot of the time. We can sort of overemphasize on what we're seeing in sort of in larger time frames. Again, outside bar here off the top, okay, inside bar here off the bottom. Outside bar didn't last very long, got taken out, blah 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 blah. But we've got a trend of lower highs. So here, obviously, the bias is to the downside as long as this trend holds. We've also got a decent Fibonacci level. Okay, so we had 61.8%. We had obviously the dollar index spiking low, which of course is spiked to the upside. We've rejected quite clearly now at 61.8%. At the moment, okay, how many trading days are we into the market? Four trading days. We've got an inside bar being posted on the monthly. If we break that down, okay, we'll lose some of these indicators as we start to move lower, otherwise the graphs are a bit awkward to use. So we break that down off the weekly, we can clearly see that the trendline resistance held very well, and the 61.8%. We can also see that this move higher, as we're talking about corrective patterns, 1, 2, 3, okay, and even this move 1, 2, 3 to the upside. Outside bar here on the weekly, which started to climb up. We have no reversal candles in this time frame. Okay. Daily. I'm going to lose this now. Actually, nowhere 61.8 is. Okay, so daily, we had some inside bars. This was over the holiday break. Liquidity was very low. It should have also been noted actually that when we got that spike higher in euro, dollar, and in cable over the break, and we actually closed down for 10-12 days because of the lack of liquidity. It should have been noted that even though those two major currency pairs made new highs, the dollar index didn't make a new low. Okay, and that is one of the reasons why I do have a large emphasis on the dollar index. So basically, obviously the bias here is still to the downside. We've had some inside bars. We've broken the outside bar. Okay, so that's basically your trigger to get short if you haven't got any signals in shorter time frames. Okay. Let me get rid of that trend line as well now because it's messing us about. Now, Elliott wave enthusiasts will be the first to admit, I would hope, that the fifth wave is the hardest wave to chart, because it can be short, it can be long, it depends where the third wave is, blah, 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 blah. So again, we go back to our fib. Sorry. Gone too high on that. Making less of this Coleman. Okay, so 161.8% lined up pretty well. So we've got wave 1, 2, down in 3, down in 4, and then a short 5. So now, with that, now I'm looking on this currency pair. I think this is probably quite a good point to bring in DMARC. Let's just get rid of that for a second. I'm going to show you. I'm going to try and overlay the two on top of each other. Come here. Okay, did pause at 23.6%, but we'll, most of the time it'll break through there. I'm looking for a move, okay, up towards at least 38.2. Now, if I pull up one of my other charts, here we go to webinar. Okay, let me just pull this in a bit. You guys see that okay still? So I've changed the charts over. Just want to make sure it's still capturing the same screen. Yeah, great. Okay, next face. Okay. Now, this is why I find it important to break down through time frames. What we're going to put on here, we're just going to overlay DMARC to start with. Okay, so it's TD sequential. Now, Tom DeMark, and I have become quite fanatical lately about DeMark indicators. Now, Tom DeMark basically sat for about 15, 17 years and plotted price action using pad and pen, basically, before it was all computerized. So a lot of the DMARC indicators he basically developed manually. Now it started as what they call a DeMarc buy or sell setup, which is the 9 counts. We then went into TD sequential, which is the 13 counts. There's a TD price flip, there's a TD wave, there's a TD trend line. But basically what he was very wary of was the fact that traders' mentality would normally mean that even though quite visibly in a decent trend, that the traders would, so DMARC basically through trial and error on his behalf and through a lot of study, he worked out where support and resistance levels were, and also where exhaustion points were. Now, what he calls exhaustion points, like I said, I think this is probably a good place to start. So this is our first wave, okay? So this is the first wave down. Now, when I talk about breaking down through time frames, you can see these 9 counts, and there's a 9 count here, 9 count here, 9 count here. You can see a lot of the time they just correct, okay? They're not necessarily a major trend change. This one is, okay? But this one just slightly moves to the upside, this one moves to the upside. This one was a decent change of trend, okay? And here is the 13 count, which basically DeMarc says you should never sell into a 13 count, okay? Because that normally will dictate a larger corrective sequence, okay? So using it in conjunction, like I said, most indicators need to be used in conjunction with other indicators. If we then go to a fib, sometimes these fibs aren't great, and that's again why I use various chart packages. Okay, then it gives us the extension levels. So here, wave 1, okay, inside bars, moves back up. Wave 2, okay, which is the 9 count, down to wave 3, 9 count, outside bar, small correction, and like we were saying, the 5th wave, you should never what? Did I say you should never what? Sorry, Cheryl was just saying. You should never sell into a 13 count. So, i.e. there's a 13 buy count there at the bottom. You should never sell into a 13 buy count. Like you should never buy into a 13 sell count. Okay? You can buy and sell into the 9 count, because the 9 count is the setup. I know it sort of sounds complicated, but what I'm trying to get through to you is that it's an indicator that you can use as an overlay, but it also can highlight the end of trends before Fibonacci, before the change in trend. So here, I said 1 down in 9. This is our 2 count. This is our 3 count. Okay, and this was our 5 count. So now, what we're basically looking for, or what I think we're looking for, is ABC. Okay, to the upside, and obviously we'll be looking for a 9 count in the other direction to dictate the move lower. Now, what he also said as well was that basically this is a TD flip, so he measures price action, because this isn't an engulfing bar off the top, it's an inside bar, but it's not an engulfing bar. Okay, so he has something which is called a price flip, and as soon as you get the number 1 in the opposite direction, it shows that you've got a price flip. But again, there's always buts, if, buts and maybes. Trading is not easy. Okay, I'm just going to delete these. Okay, what he does say is that you can tell the strength of the trend by where these counts start. So this count here is 1 count. Horizontal. Okay. As long as that support level holds on the reverse count, okay, then the bias hasn't fully changed, flipped to the downside. So this is the support. It moves up, it then changes, flips, comes down, okay. But this 9 count is not lower than the start of this TD setup, okay. So it's showing that this, even though it's a decent move to the downside, the trend change has not finished. If this 9 count had finished under here, then the bias or the trend would then be dictated to be a change of count. We move to the downside. Now, what we do have, horizontal, okay, is this resistance. So this was the start of this count, and this 9 count stopped at this resistance count, because this was the start of this TD sell setup, okay, and then the market moves to the downside, and then of course we use our fibs, etc., to dictate. So it's an add-on tool, and it's a very good tool to use in conjunction with other indicators. Now, exit trend mode. I was saying a second ago about, or not a second ago, the theme of this this webinar is to use different time frames, and I want to highlight that. So it's not just your 9 counts and your 13 counts. It's not as easy as that. Okay, you still got to be able to chart a chart. If you see what I'm saying, you've still got to be able to look at something on a vanilla basis and turn around and say, well, that price action really dictates that we're going to the upside. But then you can break it down through time frames using these DeMark indicators, using your fib levels, using your price action to get in and get decent levels. Now, looking at this now, okay, this is a 120-minute chart. You know, we said about this being a 3-wave correction. Let's just get the trend line. I know this is This was support, now it becomes resistance. Okay, it virtually lines up perfectly with that 136.87. So even though I'm bullish intraday, I would be getting out around this level and looking for reversal patterns, again in shorter time frames. Now, the thing is, if you're going to trade the mark as well, you've also got to be aware of where to place stops. Okay. Now, DMARC basically says that your low candle, you take the look at that candle to give you a stop. Now, 13 candles, 13 counts, I should say, are more powerful than 9 counts. On a 13 count, the 13 count has to be higher than the 8 count. So here, okay, it is a valid count. To place your stop. Okay, it does move lower, wouldn't have given you huge amounts. If you look to the 360 minute, which again is one of my favoured time frames, we have a decent 13 count here. Okay, but the 13 has to be higher than the 8 count, and it wasn't. Okay, so it's invalidated that count on there. Daily, 9 count off the top, 9 count off the bottom. Okay, inside bars, etc. But it's giving you a bias. Okay, so it's giving you. It doesn't always work here, here, here. Okay, and here. But if you can use it in conjunction with fib levels and you put on price action, okay, then again it's a great add-on indicator. I'm sure Tom DeMark won't mind me promoting his software too much. I thought that was important to show you today. So getting back to euro dollar, okay, expecting a pullback up, but only temporarily before we get the next move to the downside. Okay. I personally, obviously, the next target level is around 134. The figure. We're going to have to get a little bit of a jog on because it's 20 to 1. Monthly chart, cable. Consolidating triangle formation has broken to the upside, which does look bullish on the face of it, but we've also got previous area of resistance coming in here. Breaking down in shorter time frames. Using our fib extension tool again. Okay, it pushed through 261.8%. But again, this is why I'm not fanatical about Elliott Wave, but I like to use it in conjunction with other things. I like to count waves, not literally, obviously, but I want to see price action around relevant fib levels. Now we can see here that this was quite an impulsive move up, but it completely ignored 161.8%, and this was actually the corrective pattern here, and this was then the fifth wave. But we've had that bearish outside candle off the top in cable, okay, which to me, with the bias in the dollar, okay, has flipped the outlook to the downside. Shorter time frames. I'm gonna have to get rid of these again. Shorter time frames, I'm only expecting the move up to be corrective. Just what we've talked about again with our clients this morning. Okay, so we're looking for confluence areas. Okay, areas that give us chart formations, maybe give us a demarc count, and give us a measured move target. So we've had a decent move to the downside. We actually engulfed here. This is an outside bar, believe it or not, off the low, off the 2 hour candle, and then we've pushed higher. We've paused at 38.2 and we've rejected, but I don't even think in shorter time frame than them. I don't think you could rattle this all the way down to 15 minutes, and I don't think you'd get a reversal candle off the top there. I might be wrong because I've been talking to you guys. Let's have a look. No. Okay, so the bias, intraday bias, is still to the upside. Again, 1, 2, 3, 1, 2, 3, 1, 2, 3, towards this level, 164, sort of 68, maybe a little bit of a push through. Before the bias then turns to the downside. Like I said, I mean, there's no reversal candles here. There's a decent bullish candle there outside bar, which actually takes the pair up off this 15-minute chart. Euro sterling monthly. Again, if this was a 5-minute chart, you'd tell me, oh, it's just consolidating. I'm probably going to leave that alone for the day and wait till it breaks out. The bias is to break to the upside, because this is just one large channel formation. That was actually an inside bar. Inside bars here. There's an outside bar dominating price action on the way down. The reason I'm bullish in euro sterling is that I think even if you break it down into shorter time frames, and this is obviously a weekly, we've got an outside bar here, okay, but it wasn't just an outside bar. Like I said, we don't just trade them because we see them. We want to see them at relevant levels. Oh, come on. Okay, so it's just a dip under the 50% pullback level. Also, talking about wave patterns again, 1, 2, 3, 1, 2, 3, 1, 2, 3. So it's again the medium term bias is to the upside. That weekly candle gives a bias to the upside. You could even break this down into 6 hours and sort of. Okay, 1, 2, 3, 4, 5, very large channel. So 1, channeling, correcting in ABC if you like, and then down in 5, in C. So ABC. Notice this C leg's in 5 waves. Okay, so that's in 3, this is in 3, and this is in 5. Got an outside bar off the bottom. Okay, so again, it's 82.55 was a perfect ABCD formation. So you're looking for things that measure up. It's all going back to. Here you go. We'll flip back onto this chart. Backspace. Not that time frame of the daily. What are we looking at? We're looking at 240 minutes. Okay, 13 count off the bottom. Okay, where it produced. Where it produced that outside bar. Do I use stochastics to count cycles? No. I have enough indicators. I use an ATR, I use a relative strength index. I've got my own system which is based around certain moving averages. I look at parabolic ZAR in short time frames. I look at DMARC. If I'd looked at anything else, I think I'd be paralysed. Probably wouldn't trade. This morning's trades, I've shorted small myself in dollar Swiss, but the counter trend, because I do see that going a lot higher in the medium term. Dollar Swiss, I think, is in a daily ending wedge formation, just correcting, going to correct lower over the sort of the next 2 to 3 days, and then probably around 90 the figure, look for buy signals to take it aggressively higher. Dollar yen has just finished a free drives pattern. Now, a free drives pattern is again based around fibs. It's three higher highs and higher lows, with the highs extending to 161.8%, which was virtually pit perfect off the top over the Christmas break, 105.37, I believe. So the bias there is to the downside, but again, intraday we're looking for lower levels, but selling into rallies. Dollar CAD 107 is very relevant this morning. It's a 261.8% extension level. We haven't had a count there, but it's also a level that's held back bullish price action 8 days in the last 23, so it can't be ignored. Aussie dollar, I think correction higher today. Personally, I bought small around 15. I've come out too early. Euro sterling, I'm long from the other day. And euro yen, I'm going to be looking to sell into rallies, but a lot higher up, probably around 143.50. 60 averages. I know they're both around that. No, what I try and do is not look to what other people look at. Now, I know a lot of bank traders look to DMARC, but I don't look to 200, the base 200 moving average, or the 100-day moving average, or the 50-day moving average. And to sort of try to look at something that's a little bit outside the box. So no is the answer to that question. So I think I've run you through basically where I see medium-term price action going. I see the dollar index at least moving higher in the next sort of 2 to 3 weeks. I see the current moves in euro, dollar and cable, these upside moves being corrective, but probably going to extend today. Dollar Swiss, I'm looking for a move lower, like I said, to around 90 figure, and then would look for aggressively higher levels, probably around 93.40, 94 the figure. Dollar yen lower. Long-term picture in dollar CAD is very bullish, towards probably 108 the figure, but I don't think that's going to happen today, or we're not going to get a breakout. There's a trend line resistance of 107.17 in dollar CAD. So shorting anywhere around 107 the figure is going to offer pretty good risk reward today. Any questions, guys or girls? No? I don't look at sterling Aussie. I can do. I don't. Let's have a look. It's weird, isn't it? To say, so look at 13 currency pairs. People still seem to be able to find one that I don't cover. It's a good one, only if you're thinking about emigrating. And then it'd be far too expensive for me. Are we talking medium term here or short term? Sterling Aussie, or both? you've got an outside bar. It's not relevant, is it? It's a previous high. I wouldn't thought it's enough to stop this bull run, to be honest. Get rid of these again. I'd say you're going to pull back to around sort of 1800 probably to offer a decent buying opportunity to take it up towards that 32% level, which is probably around 195 the figure. Should we see what our man says? Sterling Aussie. A 9 count monthly, but it's broken this count. Okay, so this was the last bear count, and that was the resistance level. So we've broken above it. So there is a chance that you might pull back to that level off the 9 count, but not. I would have thought this 9 count off this monthly is probably, like I said, just corrective. Another 9 count with an engulfing candle, so you've got to give the short-term bias to the downside. Like I said, with that previous resistance now becoming support, I wouldn't have thought you'd get too far to the downside. Short term, I'd look to sell into gains. Long term, I'd look to buy into dips. So it's a real sort of mixed picture. I'd say sort of anywhere. Let's have a look at this. So anywhere around 185, the figure would probably offer decent selling opportunities sort of intraday over the next sort of 2 to 3 weeks down towards about 180 the figure, and then I'd look for that to reverse and then move back to the upside. But like I said, it's not something that I actively trade. And we're done. Just being told by Vicky that it's the end of our session, so I hope you enjoyed it. One thing I will say, obviously, when we produce these webinars, we get your email contact details sent through to us very kindly from FX Street. What we're doing at First for Trading over the next sort of month to two is a total restructuring of our price. So it's basically going to be packaged. Normally, at the moment, we've got FX and different individual packages. We're going to price that under one umbrella. So you're going to get all 23 products, both medium term and intraday, for what it costs for intraday FX majors at the moment. We've also got an iPhone app. So it's an iOS application that you can download on your iPad or your iPhone. That will enable you to get analysis and trade pools even if you're on the move. So we will be sending out an email in the not too distant future with regards to those new products. Okay, I hope you've enjoyed it, and I'll speak to you all again soon. Okay, take care. Bye now.